Hello, and welcome to the Long-Term Investing Podcast with Baskin Wealth Management. I'm Barry Schwartz, Chief Investment Officer. Baskin Wealth Management is an independently owned investment management firm with over $2 billion in assets under management, providing customized wealth management solutions and services to families and foundations. In this podcast, we ignore all the noise and have conversations that make sense about the things that matter in today's markets. It's what we talk about with each other here in the office, and we want to share those conversations with you. Please stay tuned for our legal disclaimer at the end of the episode. How's everybody doing today? It's May 22nd, and this is the Long-Term Investing Podcast. You know who we are, and these are Warren and Charlie Duck.
Should get a Greg Abel Ducks.
Yeah, I would want someone commented on YouTube that we should get a Mark Leonard duck, and I said we should get a Bruce Flat duck, right? All our favorite allocator and rubber. I think we could start a new business line, Ernest. Maybe if we create allocator rubber duckies, and we can make more money than charging fees from portfolio management.
I've seen a lot of people make Mark Leonard and Constellation software Lego sets.
For sure, yeah. And
I don't think you can actually buy it though.
No. It's maybe it's a like some kind of AI thing using, and we've ordered some new ducks as well. So stay tuned to see what kind of ducks are going to appear on the table. Today we got a very exciting show. We're going to talk about Canadian compounders. We're going to talk about why we think dividend investing doesn't work. We're going to get update on a few of our companies and whatever grab bag stuff Ernest and I come up with in the next 45 minutes. If you like this podcast, please subscribe to us on YouTube, on Apple, on Spotify. 5-star reviews are always appreciated. Thumbs ups, always appreciated. And of course, if you need any portfolio management services from Baskin Wealth Management, please reach out. I was speaking to clients the other day about estate planning. We have some clients, Ernest, who've been with us for 10, 15, 20 years, retired, who have way more money in retirement than they ever thought they would have, thanks to long-term investing and compounding. And, I read the other day that a lot of Canadians don't even have wills, powers of attorney, estate plans, something to think about if you now have generational wealth. And we can certainly help you and provide you with recommendations for that. So please reach out to us, and we'd love to talk to you. So before we talk about Canadian compounders, let's just quickly update on the markets. Nice recovery, of course, in May so far, as Trump lowers the tariffs on China. China lowers the tariffs on the United States. So very interesting what's going on. Of course, driving everybody crazy with the volatility, but that's what the markets is. That's what the markets do. I tweeted the other day that the markets aren't certain just because the market is going up, right? You don't find certainty just because you're making money in the market, and it's not uncertain because you're going down. It's always uncertain. But what we think is certain is to stick with the process of owning high-quality companies run by great allocators who know to reinvest those cash flows at high rates of return. And that's our North Star, and that's what we're gonna stick with. So what do you want to talk about today?
Yeah, there's a lot of questions right now that we're getting about our views on the long bond, our views on whether the U.S. is going to go into a recession, these kinds of topics.
Yeah, of course. And those are the things in the headlines right now, right? Interest rates are ticking up. So what's happening there is the interest rates on long bonds, on mortgage rates have gone up in the United States. Some are worried about the possibility of the tariffs creating higher inflation. Some are saying, well, because some of those tariffs have now been reduced, the U.S. economy will be stronger than expected. And so as a result of the stronger economy, the bond yield should go up.
And then there's the budget.
That where, if we all remember, Doge and the cutting of costs, and it's unsustainable. And then in the meantime, it looks like spending is continuing with abandon in the United States as well as Canada. So I don't think there's any fiscal responsibility that's happening. And as a result, bond yields are going up. And we saw a downgrade of the U.S. bond rating from Moody's. Of course, two other bond rating agencies, Fitch and S&P, downgraded the U.S. debt a while ago.
Right.
So it's not really groundbreaking news. I was here when the first time the U.S. government debt got downgraded. I think it was 2011. And in that time, the market really took a tumble. That was and turned out to be an amazing buying opportunity. So you should buy when people are worried about bond yields. So what do you say to clients? Let's tackle the interest question first. What do you say to clients about the long bonds and interest rates now ticking up over the last few weeks?
Well, I would say if you own a good company, then that to some degree takes care of itself.
Yeah.
Because if you have inflation, if you have tariffs, if you have higher cost of borrowing, what you want is a company that has the ability to, number one, maintain demand so that people are still buying that product even though there's uncertain economic times. You want pricing power so that they're still making money and can offset whatever's happening. And you want a clean balance sheet because then they can continue to invest and they're not paying more on refinancing their debt. And that's generally what we try to find in our portfolio.
Yeah, if you listen closely to what Ernest is saying, he just gave you the three keys to long-term quality investments, what we look for in our portfolio. I always love reading the shareholder letters by Ron Barron because every single one of them, he talks about inflation. And there's only one guarantee in this world that inflation goes up every single year, right? So once in a while we do have deflation, but the long-term trend is up. And so how do you protect your portfolio against inflation? Well, if you sit on cash or you buy GICs or bonds, you get no inflation protection. You get volatility protection, but no inflation protection. The only way to get it is to own assets that produce cash flow. And as Ernest said, companies that have the ability to offset inflation by raising prices. And that's the best way we know how to protect your portfolio with good quality businesses. The PE of those businesses is less important. The valuation less important. It's really the pricing power, the allocation of those cash flows as a long-term investor is what we look for, and really the quality of the business.
And I want to put this maybe in more direct financial terms. So Constellation Software, we talked about it maybe too many times on this podcast.
Yeah, if you like Constellation Software, check out our last podcast on Constellation Software's pivot. It is our largest holding, so it's one that we do talk about a lot.
They're able to make acquisitions at about, say, 20 to 30% return on invested capital. So when they make an acquisition, they're targeting a 20 to 30% return. You compare that to what US long bonds are. Like, let's say it goes from 4% to 6%.
Okay.
Your Constellation's compounding at such a high rate that difference in your underlying required, quote unquote, required rate of return, it's not going to impact very significantly.
That's right.
And that's kind of an extreme illustration, but if you have a company that is able to reinvest at very high rates of return going forward, that is what's going to protect you from rising interest rates.
That's right. So think about if you left your money in the bank and you were getting 4% interest, 6% interest, or you're investing at 20%. But the 20% return is a volatile return, right? It may be
it's not guaranteed.
It's not guaranteed. And one year it may be 20, and the next year it might be negative 10.
Not for Constellation.
But not for Constellation. We'll talk about that in a second. But the bottom line is, if you have the advantage to invest those cash flows at 20% over a long period of time and you have patience to suffer through the volatility, you're going to earn an enormous amount of money versus earning 4 or 6%. Now, we can understand why stocks would sell off as interest rates go up, because what you're able to do is get a guaranteed return at a higher interest rate without taking on the risk. So when if bonds went up to 6%, certainly a lot better than 4%. You may say, I don't need as many in stocks. That could put pressure on the demand for stocks. But ultimately, if a company is compounding and reinvesting their cash flows at high rates of return, it really doesn't matter what the long-term bond is.
Now, the flip side to that is that if you're owning a low growth company that has limited reinvestment opportunities, that is very tied to the economy, then the long bond matters a lot,
Okay.
because that is going to impact the ultimate return that you're going to earn on these companies. Because so now one example might be the telecoms, right? The Canadian telcos. The growth of these companies is very much tied to the population growth of Canada. So if Canada grows well, then they're able to add new internet and like mobile subscribers, then they're going to do well. In times when there is lower immigration or maybe no immigration, they're not going to grow at all.
Yeah.
So,
And that you're seeing that in the numbers of Bell Canada, where its revenues went negative in the most recent quarter.
yep. Well, no, the revenue growth went.
Yeah, revenue growth. Sorry, the revenue. Yeah. Revenues didn't go negative. The revenue growth, the year-over-year growth in revenues was down.
And so in that circumstance, the market is pricing Bell Canada as a stable cash flow business, but that is very, very sensitive to changes in interest rates. And you're seeing that to some extent over the last little while.
Very interesting. So, and what are you telling clients when they call up and ask about recession, and what should we do about it?
Well, I think the same thing that we just said is that, again, most of the companies that we own are companies that are providing an essential service or that people are going to be continuing to buy even in bad times. And sure, demand might be higher or lower in any given year, but the beauty of owning these types of businesses is that in bad times, they're going to be gaining market share. So Costco is a good example of this, where in times of high inflation and in times when the economy is not very good, people are going to shop more at Costco because their prices are lower.
Yeah.
And in good economic times, they're going to be fine as well because the economy is good.
Everybody likes to get value for their money, right? Yeah.
And so that's a pretty common theme across our portfolio, is that because these businesses are the best at what they do in their industries, they gain share in bad times and they do well in good times. And I think that's really what you want to protect you in a recession.
And what more can you ask for? So, Ernest, if I would have said to you January 1st, 2025, Trump is going to go through with these tariffs, and not only is he going to go through with them, but he's going to raise them to a unsustainable level on China, and he's going to scare every single country. But don't worry, Ernest, the stock market will be up, and no chance of recession in the short term. And you would say, that's crazy. What are you talking about? But that's where we are today, mid-May, right? All the indices around the world are up. In fact, the U.S. market is underperforming a lot of the other international markets. So we're getting questions from clients saying, is it time to buy European or it's time to sell U.S. stocks to buy Canadian stocks, for example? You have to look out a little bit longer, of course. The U.S. market has trounced the other markets' returns over the last 5 and 10 years by a fair bit. Maybe they got too expensive in the short term, but ultimately it all comes down to earnings growth. Two data points that we talked about internally here. One was just showing even though European stocks outperformed the U.S. stocks for the first quarter of 2025, the earnings growth of U.S. stocks was way better, thanks to a lot of those technology names. And the thing that you sent me about how many companies in the U.S. are at $100 billion versus the number of companies created in Europe that are that large, and there's no contest, right? The best companies in the world are built and created in North America.
That's right.
Yeah. So still, you can't learn very much, and I've said it many times, and Ernest said it too. You can't learn very much from short-term performance of any stock. Ultimately, we're big believers that over the long term, a stock's price will follow its earnings per share growth, its free cash flow per share growth, and that's what we're looking to do for you and your portfolio. So Ernest, you brought up BCE.
Yeah.
This is one that it's one that we owned for clients.
At some point, yeah.
At some point, for sure. At some point in time, Ernest, we owned very few U.S. companies, and we were highly allocated to Canadian stocks. And it makes sense for Canadians to own dividend payers, right? Because you get the dividend tax credits. You're not subject to withholding tax if you buy foreign versus buying foreign dividend payers. And over the long term, dividend payers have tended to do very, very well in Canada. That kind of hit a wall when interest rates started to tick up over the last few years. Many people would say that part of the reason why dividend stocks have done so well is because interest rates dropped in 1980 from double digits to near zero during the pandemic. And so you couldn't get good yields from buying bonds, right? You had to look at alternative sources. Maybe that play is over now that interest rates are now at a normal level. That could be one reason. But more importantly, the reason why we prefer to buy growth companies is it's really just so much more efficient to allocate cash flows at high rates of return in terms of using them for making acquisitions or building out your businesses than giving it back to the shareholders as a tax inefficient dividend. You've done a lot of thinking about this, so I'll turn it over to you to talk about the problems we have with dividend investing.
Many problems. I think the reason why people like dividends, beyond the tax aspects in Canada at least, is because it's real, tangible return to you. Like you're actually getting money back into your pocket.
That's right.
As opposed to if a company makes an acquisition instead, there's a questionable payoff. You don't know whether you're going to get your money back, and it's kind of vague in the sense that the multiple of the stock might go up or down.
That's right.
So it's not as direct of a return to you as a dividend would be.
A lot of people view the stock market as a casino, or they view it as something intangible. There's numbers on a screen moving around, but when you get that cash flow, it's real, and it feels good when that dividend comes in 4 times a year and that dividend increases.
But I think.
And people live off and people say they like to live off that cash flow.
But the reality is that dividends are a output. Like, they should not be viewed as an end in and of themselves. And the reason is that you have to really think about where dividends come from. Dividends come because the company makes money and they have extra cash flow that they can give back to the shareholders. Too often what you see is that, and you see this a lot today, where companies promise to pay a certain dividend. They'll say, we'll pay, let's say, $1 a dividend per quarter. And then the investors are like, this is awesome. We're getting $1 every quarter. And then we want you to raise it every year. And so the incentive flips around, where instead of the company saying, okay, we made some money and we're going to give you back the money as a dividend, it's give us money, give us $1 regardless of what's happening to your business.
That's right. I bought your stock for the income.
Yeah.
And if you don't give me the income, I'm going to sell your stock and your stock's going to get crushed.
And that has, and this has been made worse, I would say, because of dividend strategies such as dividend growth ETFs. There's, is it the term dividend champions?
Yeah.
Like
Aristocrats. Aristocrats is like a
screening for names that grow their dividend every year.
Yeah, for a certain level of time, for a certain length of time. That really doesn't tell you very much. Bell Canada grew its dividend for a long time, and then the next year it cuts it in half.
Right.
TransCanada Pipeline grew its dividend for a long time, then cut it in half. Algonquin Power, big dividend grower, then it got rid of most of its dividend.
And so that's why I really appreciate when a company like Tourmaline Oil, for instance, which we'll talk a little bit more about later as well, they have a dividend policy where they have their base dividend. I don't remember what that figure is, but they have a small base dividend that they're going to pay.
I think it's 35 cents a share, or it's a $1.40 or something like that.
But then on top of that, they have a special dividend, which is not guaranteed, but they say, we'll give it to you depending on how much we're making, because natural gas prices are going to go up or down.
Yeah.
So in good times, you're going to get more special dividends. In bad times, you're going to get less special dividends. But there's no obligation on the part of the company to continue to make these payments, and you shouldn't count on it.
And then that variable dividend is really dependent on what's the best use for the cash flow. If Tourmaline said, you know what, shareholders, we found a great acquisition that we
Yes.
want to make. We're not going to pay you a special dividend this quarter because we need that cash flow to pay down debt from buying the acquisition. That's what you would want. You'd want thoughtful. In the real world, companies should use this approach to dividends. They shouldn't have they should have a very low set dividend and then a variable dividend based upon whether it makes sense to pay the dividend, pay down debt, make an acquisition, expand their business. That's really how companies should think about dividends, not I'm paying you a dividend and I just hope I can raise it to you every single year until bad stuff happens and then I have to cut it.
And I don't want to pick on BCE,
No.
but they are really the poster child of this, where they were so committed to raising the dividend every year that they, like, you could tell, like, a couple of years ago, the competitive landscape was getting worse. The consumer was getting worse. There was real competitive pressures in the wireless space. They had, like, the growth was simply not there, but they were still trying to raise their dividend, even if it was by a penny, while they were selling the sports assets. They were laying off people. They were cutting costs just so they could continue to maintain the dividend.
Yeah.
And so if you're a shareholder, you really have to ask yourself, well, am I really making money because of an excess distribution of profits? Or is the company just selling the furniture just to keep warm?
Exactly. And if Bell would have kept that money to reinvest in its business, I mean, some businesses doesn't make sense to reinvest, right? Where you don't need the cash flow. The business is humming along. There's nowhere to put the money into. You allocate it, like a BCE already tried years ago to get into the media business and all these other internet things, and that didn't work out. That was, if people remember the .com bubble, BCE owned Nortel. They owned all these different things that turned out to be disasters, but and you look at years ago, Coca-Cola used to be in fish farming, right? And think they owned a movie studio.
Yeah.
Now they're just focused on snacks and drinks. So you don't want necessarily to have companies to reinvest the cash flow to build out an empire that may not make sense. So you got to take each stock one by one, each company one by one.
I think that's an important point. Like, we're not against dividends. We're saying that a company should carefully evaluate how much money it's making.
Yeah.
It should invest if there's opportunities to invest. And if it doesn't, it should give it back to the shareholders.
That's right.
But they shouldn't prioritize the dividend as an end all and be all. That's the main point.
But you show me the incentives, I'll show you the outcome. There could be a large family ownership in the company, and that's how they get paid. They have such a low cost based on their shares. They don't want to sell shares to pay capital gains, so they rely on that dividend. There's sloppy thinking that goes on in all types of businesses, and dividends are just part of it. It should be part of a thoughtful capital allocation. And I think the example of Tourmaline and CNQ and some of these other oil and gas companies are companies that are doing it right. Warren Buffett said, I'm not going to pay a dividend. I paid a dividend once. It was the biggest mistake. It's so much more efficient because the dividends that I get from all the operating businesses go up to the parent, Berkshire, tax-free, and we can invest it tax-free. But maybe at some point in time, Greg Abel may say, we just have no place to put the money, and maybe we should start paying it out to shareholders as dividends. I'm not saying that would happen, but you have to think about, I've got all this cash flow. What are my best options for my shareholders?
No, and I think the Berkshire and Constellations are good examples of this, because the entire thesis for these companies is that you think that Mark Leonard and Greg Abel or Warren Buffett are going to allocate the capital intelligently.
Better than you can.
They're able to make money in excess of what you would get just from buying the S&P 500 or the TSX or any random stock index.
If you look at the best performing stocks, pick a country, Canada, US, whatever, they're certainly not companies that have high dividend yields.
Yeah. And so why would you want Berkshire or Constellation to pay out a dividend where you have to pay tax on it when they can reinvest that money at a higher rate of return and defer the tax on that indefinitely?
Yeah.
So that's really the basic math of why we prefer compounders rather than dividend payers.
It's such an advantage. And once you find that, finding great capital allocators is not easy. There are a number of great capital allocators, but they're rare. And once you find a company that is great at allocating capital, you should tend to stick with them. We own TFI International. They are great allocators. Their business right now, fundamentals, not as great as it was, but because we believe in the capital allocation abilities of the management team, and we believe in the business cycle will come and go. TFI, we think, will allocate capital in tough times and take market share and make its business even better when the cycle recovers to good times.
That's really a common theme among the names that we own, is that they don't kind of I don't even know if I'm using the word right, but they don't have a fixed capital allocation process where they say, we're going to buy back this much stock every year, we're going to pay this much dividends, we're going to do this much of M&A.
Yeah. The world changes.
Yeah, they just take a flexible approach. They see what is out there, and then they'll adjust if necessary.
Yeah.
And that's...
Why do you think, a little off topic, why do you think that Google and Meta started a dividend recently? What was that all about?
Yeah, so I think it's a very small dividend.
Yeah, they're very small dividends. I think they're both less than 1% yields or 0.5% yield.
I think the reason is really about indexing. Mm-hmm. And there's a lot of money out there in so-called quality ETFs. So they use simple screens for business quality, maybe has to have a dividend, it has certain returns on invested capital, they have certain margins, certain growth. And if you want to be part of those indexes, you have to pay a dividend.
There you go.
And so I think it makes sense to have a little bit just to kind of show that the cash flow is real. Not saying that anybody thought their cash flow wasn't real. Yeah. But you need real money to pay a dividend.
Yeah, there's some fund managers, ETFs, even investors that say, if there's no dividend, I'm not buying it.
And that goes all the way back to like year one finance class, where you say the present value of your stock is the value of the dividends. Mm-hmm.
But you don't. It is the present value of the dividends, whether you get all the dividends in the short term or you have to wait 30, 40 years to get them.
Right.
It all depends on your long-term investing horizon. Anything else you want to talk about in terms of dividends?
Yeah, one last thing.
All right.
Is that I think it's the silliest thing in the world to screen for high dividend stocks because there's no other world investment class in which people do that and think it's a good idea.
Okay.
In fixed income, in bonds, if you look at the high interest rate bonds,
the highest yielding bonds,
nobody looks at a high yield bond.
They're the crappiest companies.
Yeah. And in a high yield bond, that is guaranteed payment to you. Guaranteed in the sense that the company has an obligation to pay interest to you. Yeah. Nobody looks at that and says, wow, this is such a great deal. I'm getting an awesome return on my bond. They understand correctly that these are riskier investments that are paying a higher rate of interest to compensate for the higher risk.
That's right. So if you were attracted to the BC yield when it was 8% or 9% or 10% or 11%, I think it got up to 12%.
Yes.
You're looking at the wrong things.
Stock went up when they cut it.
Yeah, now it's back down again. So BC has cut its dividend by 60%. The yield's still high. But so what do we look for in terms of dividends? For us, where do dividends come from? They come from the excess cash flows that companies, they should come from the excess cash flows that a company generates after paying all its employees, keeping the lights on, so to speak, right? And so with this leftover cash flow, it's an easy number to calculate. It's it's just net income minus capital expenditures, and you've got what's left over. The issue is, and maybe add back depreciation, I missed that one. But the bottom line for that is, if you see a company that year in and year out is paying out more in dividends than the free cash flow that it's generating, you probably are going to have a problem, unless it's a temporary So like during the pandemic, right? A lot of companies still were paying their dividends, but the business was a zero for a few months, right? You can suffer through that because you know the company has a good balance sheet, and when things recover, the dividend will be fine. But BCE was paying out more than it was taking in for a number of years. And for some strange reason, raising that dividend. So that makes no sense. So what has to happen is the debt goes up too much, and investors eventually figure out that that's not sustainable, and that's why BC's dividend went to 12% because everybody knows they're going to cut the dividend.
I think, are we picking on BC too much?
We are, but it's a good example in the news and a good example to explain where we're coming at in terms of dividends. So we push back on clients who say, I need dividends or I need a specific yield. We think that's the wrong approach. We think the right approach is to just, as we talked about a billion times here, own better businesses with growth opportunities. And, it's going to be hard for anybody to change my mind based upon that.
No, we've tried and we've tested at Baskin. We've had internal testing of strategies that are catered to people who want income, that want a lower volatility strategy. And we actually had tried to look for some of these companies that were both higher quality and paid a good dividend, right? And we tried it for a couple of years.
What we're saying is paying a good dividend, like a yield that is a 3 or 4 or 5%. Yes. Not like a lot of our companies pay dividends, but their yields
like 7%.
Yeah, but their yields are very, very low, right? Yeah.
And not a single one of those names has really worked. And I think there's a reason for that. The reason for that is because the primary focus is wrong. It's not on whether the business is a well-run business, whether they have good growth opportunities ahead of themselves, and whether they're allocating capital effectively. What you're looking at is the dividend.
Yeah.
And so, and the reality is that the business world, even if you are a capital light, low investment business, like the business world is hard. You need money to grow your business. Mm-hmm. And if you're paying all of your money as a dividend, then you're going to need to find other ways to come up with money to grow.
Yeah. And so I think that's a very truthful statement is we haven't found much success in that arena. There's been a few companies where we've owned exclusively for the dividend that worked out, but more often than not, they don't work out. Either the stock price doesn't go, or the stock price goes down because the business is not a good business, it's a mature business, or the company cuts its dividend, or whatever else happens. So we're not interested in buying based on yield. We're interested in buying based on business quality. And that's the key point of this message. Let's catch up a little bit on some of our Canadian names. We talk a lot about Brookfield and Constellation and the big techs. Yep. Those are big positions for us, but sometimes, Ernest, we don't talk about the First Services of the world, the Waste Connections, the TMX Group, the Restaurant Brands,
CCL Industries.
CCL Industries, which these are Canadian businesses or Canadian tickers that some of them are serial acquirers or good growth businesses that not so sexy. Who wants to talk about garbage, right? AI,
they are using AI.
How?
Okay, well, finish.
Yeah, but So but there's gold in garbage. There's gold in labels. There's gold in the businesses that make these mundane products and services. Some of the best performers over the long term have been a pest control company like Rollins or O'Reilly making auto parts. We own a very boring business called Copart, is in the auto auctions, junkyards, but it's done tremendous. One of the best performers. Monster Beverage, we don't own it, but that's been a tremendous stock performer. One of the best performers on the Toronto Stock Exchange up until we bought it was Couche-Tard.
Yes.
Yeah. Couche-Tard is a gas station and convenience store. There's nothing sexy about that.
Apparently people don't like it when you say that, Couche-Tard.
I don't care. So they like me.
Okay.
So let's talk about, let's start first with Alimentation Couche-Tard. The stock is, since we bought it, quite frankly, has not done well. We bought it. Our timing probably was, not the greatest in the short term. Timing in the short term is a gamble, anyways. But two issues: the higher inflation, tougher economic situation for some of lower income consumers means they're trading down. Maybe they're not buying the higher end drinks or cigarettes or beer at the convenience stores. Maybe they're not buying the higher end gas. They're buying the lower end gas.
Filling up less,
like all these things, plus the ongoing saga with will it or will it not acquire 7-Eleven. And so the stock has been under pressure. We thought it had turned a quarter the last quarter when it reported much better results. Earnings are coming out for its most recent quarter in June, so we'll see if that trend continues. But, any news on Couche-Tard to update?
So on the 7-Eleven front, they recently finally got approval from 7 and I to examine their books. So that is an important step to seeing whether they can improve their offer for the business. For those who haven't followed, 7 and I has kind of tiptoeing around the deal process, saying they were open to it, but also kind of not open to it, and pursuing a possible listing of its U.S. business in New York.
So 7-Eleven, I think its biggest worry is that the merger won't go through regulators because of the overlap of assets of convenience stores, of Couche-Tard's convenience stores, which are Circle K and 7-Eleven, and be like a monopoly, too many stores in the same locations, and that's the worry. And regulators will say, no, you're not allowed to buy it, or you have to sell off so many assets that it doesn't make sense to merge the companies.
Both companies have kind of gone through a he said, she said with regards to the deal, where one company says, this is what we want. The other company says, no, that's not what actually happened. This is what actually happened. Mm-hmm. But basically where we are today is that they are in talks of a combination. And my guess is that we'll probably see some improved offer from Alimentation Couche-Tard for the business. Then whether they accept or not, and how that antitrust process goes, we'll see. Because Couche-Tard had said that they were open to taking on a lot of the antitrust risk through providing a substantial break fee. So we continue to think that it's a great deal, even though maybe a little less attractive now that the stock price has fallen. Mm-hmm. But I think it's a once in a lifetime opportunity to grow the business. And I think they'll do very well with it if they're able to move on.
So Ernest mentions because the stock price has fallen, Couche-Tard was going to use part stock, part debt to acquire 7-Eleven. When its stock was trading at $80, that's more attractive than when the stock is now at $68. They'd have to issue more stock to get the deal done. And that's more dilutive and makes the return of the merger, if it works out, less attractive. And so the market is obviously the big decider here on whether that's going to go through or not. But talk about capital allocation for a minute on Couche-Tard, because it's indicative of what we're looking for, right? Couche-Tard is it has a dividend. It has raised its dividend many, many years, but it feels it can earn better returns either buying back its shares or making acquisitions, right?
Yep.
So it targets 15% returns on?
Yes, 15% return on invested capital.
So this is exactly what we're talking about, right? This is the bank account where you can earn 15%. And so Couche-Tard, by making acquisitions and by implementing better strategies, what have you, it's met those hurdle rates over the years. And it's been one of the strongest performers on the Toronto Stock Exchange for a very long period of time. We still think there's a big upside on the stock, but we have to see how this deal works out. If it doesn't work out, Couche-Tard has stopped its share buyback, so there's potential for a lot more buybacks or even more acquisitions of other companies. They say they're full looking at lots of different companies. So if they don't get 7-Eleven, it may be something else in Europe or United States.
On the macroeconomic front, I think it's fair to say that the low-income consumer is probably not going to be getting better anytime soon.
Probably not.
I think everybody is a little bit benchmarked to the 2021, 2022 period when everybody had stimulus checks, they were all spending, everyone was stuck at home. Today, we're just not in that environment anymore. So I think they'll still be fine because these are convenient products that people need kind of buy on a daily basis. But I would not expect very strong growth on that front. So,
okay, let's move on.
So I think to sum it all up, the opportunity for Couche-Tard is really around capital allocation. And we think that they're going to continue to do that.
So what's going on with the oil stocks? Our clients own shares, and I own shares of CNQ and Tourmaline. CNQ is more focused on oil, Tourmaline on natural gas. We've seen the price of oil go down this year.
Yep.
A, worries about recession, slowing economic outlook. B, just maybe increased production around the world because people are taking advantage of the higher oil prices that we had over the last few years. Just money flows in and out of different sectors. But natural gas prices have ticked up this year because it was a very cold winter. If you live in Toronto, I think we're still in winter. It's May 22nd and it's rainy and freezing outside, and I'm still using my heat. I don't know about you, but the share prices of oil and gas companies have been, they haven't reached their heights that they did a few years ago when oil was at $100 a barrel.
Yeah, and unlikely probably to go back there anytime soon.
For sure. And that was a circumstance where the Russia-Ukraine situation really led to higher oil and gas prices. We own these companies not necessarily to bet on higher oil and gas prices over the long term. We own them because they're great allocators, because they know how to keep costs under control, and because they can grow production. And because we think some of these, they have some nice tailwinds to some themes, maybe building out data centers, the electrification of the grid, that could be really good for natural gas.
Yeah, I think the focus really is on that these are, at the end of the day, really well-run companies that are going to make money in almost any environment of commodity pricing.
Yeah.
If we look at Canadian Natural, I think they're best in the industry in terms of allocating capital, in terms of operating the business to controlling costs, so that even when oil prices were $40 a barrel, they were still making money, they were still paying their dividend. And especially in bad times, which we've kind of been in since 2015 for Canada, they are able to make acquisitions from other oil companies who are not as good as operating their properties and drive improvements in those properties as well. So
Canadian Natural Resources in its first quarter, just a terrific operation quarter, record production, kept costs under control, where it was able to capture some good pricing on oil and gas because of the improvements in natural gas prices.
Differentials too.
Yeah, differentials, paid down debt. We talked about it a number of times on this podcast. CNQ made a number of acquisitions to get more oil sands assets. We've seen, Ernest, a big takeover offer for Meg Energy, which is another heavy oil player in Canada. There's some expectation that possibly CNQ or Suncor could also bid for that asset. Who knows?
Probably not CNQ right now because it's not really synergistic with its existing assets. I think that what CNQ did, I'll get back to the Mega Energy thing in a second, but what CNQ did do is that they are going to be getting 100% interest in one of their oil sands assets. And the opportunity there is not that they now, own 100% of that asset, but that it allows them to increase their share of production without actually growing production from their oil assets. And because they're better at operating it than everybody else, they're going to save a little bit of
They
money.
don't need partners anymore given their size. Tourmaline has also been quite busy. 2 more acquisitions that it made in the quarter, and the company that's looking to acquire Meg Energy, Strathcona raised sold some assets to Tourmaline and as well as another natural gas producer to get more cash on their balance sheet, possibly to make that acquisition. So, any updates on Tourmaline that you want to share?
So the play for Tourmaline over the last, basically since its existence, has been to consolidate the natural gas plays that it's in.
Mm-hmm.
So right now the focus is in what is called the Northeast BC Montney play, and that's the play that is closest to service LNG, because that's where the Coastal Gas Link is connected to, and that's where all the gas is.
So it's trying to get more scale in a specific basin. As it gets more scale, there's advantages, operating advantages, and cost advantages, and you name it.
And the benefit of having the scale is that Tourmaline and ARC, which is the other player acquiring these assets, because they have scale, they're able to sign long-term marketing agreements with other partners, and they're able to sign marketing agreements with other how do I say it, like with pipelines and other offtake places so that they can get higher prices for their gas. They're able to commit space on pipelines so that they are having access to other markets.
Yeah,
Tourmaline, and they own all their facilities so that they're able to drive costs lower. And what you're seeing in the gas space is that Strathcona decided that they didn't have the scale to participate in this area, and so they're selling their assets to Tourmaline for stock, so that they're able to participate in the upside as well.
Beautiful.
But handing the assets over to in the NEBC Montney to more experienced players who have the scale and who are able to make the best of them.
Sounds very bullish for Tourmaline.
Yes, I think the idea for natural gas is quite different from oil in the sense that Canadian oil was not constrained to the extent that I think it's often made out to be. Mm-hmm. You could have moved it to other markets through rail. You could have moved it down through the U.S. Gulf Coast. Canadian oil producers were able to move the oil to other markets. That hasn't been true for natural gas because you actually have to have the facilities in place to be able to do that. And so that's why Tourmaline has been very patient. They haven't ramped up production, but they've been building up the resources in advance of LNG Canada starting up, which is expected to raise natural gas pricing and then ramp up production at that point. That's what's happening with Tourmaline.
So I think we're going to leave it there. That will be part 1 of our coverage of some Canadian compounders. And I'm going to be off next week, so we'll do a podcast in a couple weeks, and we'll cover some more of these Canadian names, TMX Group, First Service, CCL Industries, maybe talk about TFI.
Yep.
And we'll have also some more earnings to talk about, I guess, so as I think Copart is releasing earnings very shortly.
Tonight.
Costco, and the time just flies here. So that's all we got for you this week. See you back here real soon. This podcast is for informational purposes only, and any forecasts on the economy, markets, or individual securities should not be viewed as investment advice, a recommendation or an offer or solicitation to buy or sell any securities. Clients of Baskin Wealth Management and the speakers on this podcast may own shares of the companies discussed. Information on this podcast is current as of the time of production and is subject to change. If you have any questions or would like to subscribe to these podcasts, visit our website at baskinwealth.com.